Good evening, everyone. I'm CA Akanksha Gupta, the moderator of this webinar. We are delighted to welcome you all in the webinar being organized by the Continuing Professional Education Committee of ICAI. It is my pleasure to be the moderator of the webinar on opportunities in derivative and startup valuation. In a short while, we will start this webinar. First, I would like to apprise you about the CPE committee. In today's ever changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of the game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date and to offer unique guidance and influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continued professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve professional goals through webinars, seminars, etc. The program for this evening is as follows. We will have two sessions of 1 hour each, and the topics are opportunities in derivatives and options, and startup valuation. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. Before commencing the webinar today, I would like to read out the biodata of Chairman Sir Shri C.A. Purushottam Khandelwal Sir. He is the chairman of CPEC and convener of RPA Directorate of ICAI. He is having 25 years post-qualification experience in the field of audit, direct and indirect taxes, and intellectual property rights. This year, he is devoted to fortifying CPE framework and guaranteeing quality across entire operational spectrum. And this year, major focus would be on upgrading the CPE portal for enhancement of the branding and professional competency of the members. Now I request CA Purushottam sir to deliver a welcome address to our esteemed audience. Over to you, sir.
Good evening, respected immediate or a past chairman of the Rajkot branch of Gujarat, Hardik Bhai Vyas, moderator Akanksha ji from Satna MP, Nirmala ji, second faculty, secretary of the CPEC, Ajit Naji Tiwari, office of the CPE committee, respected member. It gives immense pleasure to be amongst you on this Wednesday evening. Every Wednesday is dedicated to members, and my committee is organizing a webinar for the member of the professional interest. CPE committee is a mother of all the committee. My committee is continuously organizing a conference, half-day seminar, full-day seminar, webinars, residential refresher course, workshop for the updation of knowledge of the members. I would like to say that every members, those who are in practice or in industries, must have a reading habit, because what we are going to deliver today may be outdated. Learning, de-learning, and relearning is my welcome to the vice chairman of the CPE committee, GC Misra ji, to this webinar.
Thank you, Chairman sir.
I will 2 minutes में खत्म करता हूँ sir. So member has to de-learn and relearn. जो आज पढ़ा है वो कल पुराना हो सकता है. Companies Act 1956 is now outdated. Now new company law in force. Income tax every year there is a changes. So we must have a reading habit. What we are selling? We are selling our services. We are selling our time. So we have to price tag of time. If the advice given to client may be perfect, relevant, and current. So CP committee is doing dedicated efforts to organize this webinar and seminar for the members at every Wednesday. This year, we are planned to come out with the dashboard. Ajit ji and we everybody know that the one dashboard will be there. We will register all program of 175 branches in the same portal, and you can choose your professional interest topic and attend the programs. You have to pay money from the single window and will send to the respective branches. We are also looking for the CP chapter and circle. We have a jurisdiction of the CP chapter and circle. They are also arms of the ICI. They are also doing a wonderful program in their local area where there is no branch or there is a regional council. So we all, this year we are organizing one All India Management Week where we invited the branch managing committee and also we invited the deputy convener and convener of the CP study circle. So I will not take much of time because the topic which is selected is the derivatives. So you earn the money which the Hardik Bhai suggests you and you invest in the startup which will be suggested by Nirmala ji. So I welcome both the faculty. One, give you the source of earning, another, how to invest. So welcome to this webinar. I will not take much of time. Gyan Mishra sir is here. They will address you. Akanksha ji, over to you.
So thank you very much, Chairman sir, CA Purushottam Khandelwal ji, two very learned speaker, Hardik Vyas ji and Nirmala Soni ji, moderator, very young Akanksha, and of course the secretary of the committee, Ajit Nath Tiwari ji, and the entire team. Good evening to one and all. Friends, it's indeed a great pleasure and privilege to interact with you all in this very, wonderful webinar which has been organized on every Wednesday, 4 to 6. So at the outset, I'm very much thankful to the leader of this committee, CA Purushottam Bhai Khandelwal, who has done so many
leader, sir.
so many activities for the committee this year. And of course, so many reforms are underway. I hope that Purushottam Bhai must have, briefed about the technological development and few of the reforms with respect to the committee that has been undertaken this year. Friends, both the sessions are really very important. One derivative which is going to be one of the core area of, I will not say practice, but certainly of earnings for the members at large across the country. Chartered accountants are so much involved in the stock market, and that's how we are seeing that the Sensex and Nifty are touching a lifetime high on day-to-day basis. And Hardik Bhai will be briefing about how to play in the derivatives and what could be the major things that we have to keep in our mind. The other speaker, Nirmala Madam, shall be taking valuation of the startup. So that is also a very important topic because nowadays we can see that so many small and medium companies are coming in the IPO through the main board. So startup, to understand the startup of the valuation of the startup and how to invest in that and how to come with the actual price of those startups. That is to be explained by Nirmala Bhai. Friends, I'm sure that these weekly webinars are knowledge enriching to all of us, and this is the time when we have to learn, we have to upgrade ourselves. One very important thing that is taking the entire gamut of the technology in itself, that is artificial intelligence. So Institute has come up with Artificial Intelligence Committee also. So many programs are organized. 2 days back only, we had, yesterday itself, we had this program of National Conference in Hyderabad. So areas for practice for the chartered accountants is too high in coming time. So it is on us how we are utilizing the time and how we are focusing for the newer applications. I'm sure that with the change of technology, with the newer avenues, and with the thoughts and intelligence that the profession has carried for the last 75 years, we shall keep on providing the best of the services to the society at large. And most importantly, the brand CA will keep on flourishing in coming time. Thank you, Chairman sir, for giving the opportunity. And the last thing that I would like to request all the participants that if any one of you is desirous to be a speaker, moderator, writer, or any type of support or any type of suggestion for the committee, please do write to us. And CPE committee is your own committee, because anything starts from CPE. So we are dedicated to provide best of the services from the committee. And I wish all the best for the happy learning to each one of you. We shall be meeting on next Wednesday again. Thank you very much.
Thank you,
Thank you,
sir, for
Gyan.
your words. Thank you, sir, for your words of wisdom. Now, before beginning the first session, let me introduce today's first speaker, CA Hardik Vyas, to all of you. CA Hardik Vyas, sir, has more than 15 years of experience in capital markets, focusing on derivatives. He was the chairman of Rajkot branch for 2021-22 financial year, which was awarded as the best branch at the regional level, and he was also the co-opted member of Board of Studies Operation at ICAI New Delhi for 2023-24. He is a visiting faculty and has delivered multiple sessions across various platforms, including ICAI. Over to you, sir, for your deliberation.
Thank you, Akanksha for the nice introduction. Uh, I'm very much thankful to the Institute of Chartered Accountants of India, specifically chairman of the CPE committee, our own from Ahmedabad, very dynamic person, CA Purushottam Khandelwal ji, along with the vice chairman, CA Gyan Chandra Mishra ji. My regards to the co-speaker, Nirmala Soni ji, and thank you, Ajitnath Tiwari ji, for handling all this stuff at CP committee. And I am again thankful to the ICI for giving me this opportunity for sharing my views on the one of the important topic with respect to stock market, which is called derivatives. Friends, let me start my session by sharing the presentation. Friends, let us start. I will be talking uh, in a specific segment called derivatives, which can be referred as options as well. So before I start, my disclaimer will be that I am not a SEBI registered person. This seminar is purely conducted for the educational purpose of our members. Neither me or this organization, ICI, will be responsible for any losses or damages, if any. So please consult your financial advisor before investing in this kind of market. Friends, recently SEBI has come out with the one of the disclaimer, one of the important data we can say. Out of 10, 9 individual investors are making loss. So please be very careful uh, with respect to the option trading, as this segment is considered as one of the most uh, riskier segment across the stock market. Although stock market is also termed as a riskier segment, but options are a bit advanced level of the product of the stock market. So Let us understand the risk before jumping into the market, and I will try my level best to justify the topic within the given period of time. So I am just starting from the scratch. I will be a little bit quicker in terms of the concepts, and whenever I feel that time should be given to a particular slide, we will go accordingly. Please be with me for the next 45 minutes. You will be able to understand the basics and some of the advanced concept of the options. Thank you very much for joining in. So, friends, first of all, if we think about options or derivatives, we just think about the stock markets. Some of the important points I wish to cover initially. One is capital or stock market. We can say stock market is a market where the trading of a stock or a particular commodity is happening. So, friends, coming to the Indian environment, we are having two platforms where these kind of tradings are going on. We can say these two platforms as an exchanges. Currently, two exchanges are there for the stocks: National Stock Exchange and Bombay Stock Exchange, which is abbreviated as NSE and PSE. Coming to the larger concepts of the capital market, we can have defined in a different segments. For example, one segment is cash segment where we actually buy and sell the securities or stocks, and another is F&O segments, which is called future and option segments. So these are the two separate segments, and our focus of the today's webinar will be on the second part, which is F&O segments. So coming to the derivative parts, these are the very basic concepts. I will be very quicker because we will be mainly focusing on the fourth and last options. So forward, future, swaps are the three type of the contracts, and we will be focusing on options. Because want of time, we will be a bit quicker in terms of the options. Friends, basic definition, if we say that an option is a derivative which gives a right but not the obligation, and which is having two important aspects. One is expiration date. We can say expiry date. By this means a particular contract is going to expire on a particular date, which is called as expiry date. And the strike price. Strike price means a particular price of an option. We will explore this strike price by way of example on later part of this webinar. So these are the options. We will be focusing on futures and options only. Coming to basics of options, I will be very quicker in this basic part. For example, there are two terminologies. Two types of options are there. First is call option, which is abbreviated by CE. Call option gives right to buy a particular asset at an agreed price. We have seen one important concept in earlier slide, which was a strike price. Here at an agreed price, which means a strike price on or before a particular date. On or before a particular date it means a expiry date of a particular contract. Second aspect is put option, which is abbreviated as PE, which is also having same logic and same terminology, but here you will have option to sell a particular asset at an agreed price and at a particular on or before at a particular price, date. Friends, there are five important concepts of options. We can say components of options, which is called as Greeks. Our main focus will be on two of them in this webinar. Although these five components carries a great importance in itself in a particular way in an individual capacity, but our main focus will be on um, two of these only Greeks. First of all, we will be focusing on data, and second, we will be focusing on theta. Other are the theoretical concepts which is not relevant as of now, as my session is designed in a way that we will be dealing with two of the five deltas, which is called as Greeks. Coming to first part, delta means delta measures an option price which can be moved for every 1 rupee change in the price of underlying asset or index. Friends, in earlier slide, we talked about both of the exchanges. One is BSE and second is NSE. Both of the exchanges are having one indicator, which is widely known as index. BSE has Sensex and NSE has Nifty. We will give one example through this concept so you can have better understanding. First of all, if I say this option is having zero point 0.1 means 10% of the delta, it will mean, for example, if we talk about Nifty, if Nifty moves 100 points upside from this current market price, then if my option is having delta of 0.1, then my option price will be affected by 10 points. For example, in this example, Nifty is moving upside, so my option price will be moving upside as well. But Nifty is moving 100 points. By this delta, my option price will move only 10 points. So I think it is clear. This is the important point. Point 1 delta means it will be affected by 10% only. So we will be moving further. Gamma. Gamma is also one of the important concepts, but we will be skipping as of now. Third one is theta. This is the important aspect of the options. For example, I am entering into the contracts of a particular asset to buy or sell, which will have one expiry date. For example, we can say hypothetically 31st July. By this month, I will execute this contract. Either I will execute or I will not execute, though this contract will expire on 31st July because it has the validity of a particular period. So this component is called theta. Theta means time value. I have another 13 days after today because today is 17th. So 13 more days I have with this contract. So theta value accordingly will be adjusted in a way. So coming to the theoretical concept, theta refers to the rate of decline in the value of option over a time. So for example, theta value is rupee 1 today. By the passing time, it will depreciate it, and at the end of the day, at the end of the month, say for example, on a last day of this month, which is the last day of the agreement or last day of the contract, it will be depreciated to the zero. So for example, today the value is rupee 1 hypothetically, it will depreciated over a period of time. So for example, if we depreciate the constant value of rupee 1 divided by 13 days, so you will get the depreciation of time value of money over a period of time. This is the simple concept. When your expiry comes nearer, your value of theta will be the lesser. So coming to next concept, we have understand uh, both of the concept delta and theta. We will apply this concept in our upcoming logics. Vega means volatility. Friends, in options, one of the concept is volatility, which is one of the most important concept. Volatility means the fluctuation in the price. What does it mean? Fluctuation, increase and decrease in a price in a way that is abnormal. We can say volatility increases. For example, I can give you one example of a real estate transaction. We are moving out of the stock market for the sake of better clarity. For example, friends, I wish to purchase a piece of land at a particular area. Rate of that land is approximately rupees 50 lakhs. For example, I am willing to purchase that particular land. Current market price is rupees 50 lakhs. Now imagine a situation, government has made some announcement that beside this piece of land in a nearer area, one airport is going to be built up in a future. Now what happens with this land, friends? More buyers or more sellers will come to play because the interest of the buyers are increasing. We can predict that by this announcement. This is the pleasant announcement from the government. By this announcement, I predict that the land price will increase. So we can say more buyers are willing to purchase. So we can say demand is increasing, supply is limited. What will happen? Price will go up. Normally, for example, in a routine inquiry for that piece of land, normally 5 to 10 buyers are coming for the asking of the price. Now, after this announcement, this volume will drastically increase. So, we can say there is a fluctuation in price. In a way, we can say volatility has increased. So, friends, in stock market, any such news which can affect the markets positively or which may affect the market negatively. So what will happen? More buyers or more sellers will come to play the prices. So implied volatility is a concept. We will go in depth a little bit later. But coming to our next component of the options row, again it is a risk-free rate of interest. We can say, for example, bank FD rate, government bond rate, which are considered as the comparatively risk-free interest rate. So this segment will affect also the price of the options. Some of the important concepts, friends, for example, option chain. If you are dealing in the options, you will have a price list of a particular uh, stock or particular underlying asset. So in option chain, you will have certain informations. You can have strike price, you can have last traded price, you can have the open interest, etc. So many informations are there at a particular chart or at a particular place. We can say this particular information or gatherance of this information as an option chain. Second thing is implied volatility. We have understood the volatility by example. So friends, here implied volatility means which is calculated by a mathematical formula which is very widely known, but in recent scenario we do not have to calculate each and every calculations. It is automatically calculated and made available to us. So I am just going to share this information with you that this is the screenshot of NSE website. This is the Nifty option chain. Some of the important headers I can read out for this kind information of you all. In very middle, there is one header called strike. Strike price means the uh, price of a particular option in which trading is happen. Each strike price has been considered as a separate asset. So these are the strike prices available. Bid and ask rate, buying and selling rate. LTP means last traded price, and beside the LTP, in both side, one side is options, call option data, and right hand side is put option data. So IB is also there in option chain. IB means implied volatility. It is already calculated and given by the exchanges. Some of the advanced softwares are also available as a freeware in the market. You can have implied volatility of a particular asset in a real time basis. So this is the option chain which is available at the NSE website, and this is the option chain of the Nifty. So you can have the so many options at the Nifty website, different expiry dates, different underlying assets. So you can go there and explore it at a later on. Coming to the implied volatility concept, how it is calculated, you can just Google it out. You will have the formula. But this is the simple for the sake of our knowledge that implied volatility is calculated by a particular formula. Friends, coming to this concept along with the option, when I say this particular option is having low IV, which means option price will be lower. Remember the example of land I was willing to purchase before the announcement? There were no specific moments. Once an announcement came, more buyers come to play the prices. It means before announcement, we can say there was a low IV, means a fair price or low price. After the announcement came, we can say there is a high IV, means the price will be the higher. So friends, it is positively correlated with the price. IV is positively correlated with the price. If we have seen the low IV, we may face the low price. High IV means high prices. So this is the simple concept. Coming to our options, friends, before jumping into the option, let it be very clear that we should have the basic knowledge of the market, where the market is heading. For example, if I do have knowledge of the market, then I can enter into the market. So basic knowledge is I should know that tomorrow or in coming days where the market is going. It means prediction. I should have the knowledge enough to predict the market. For example, hypothetically, as I mentioned earlier, that this is the educational purpose only. If we predict that market is going to upside, then as a layman, what we should do, we will buy a particular index or we will buy a particular script. We will intend to sell at a higher price to make some profit. This is the knowledge of market, which is very simple in terms of concept, but very much difficult in terms of implementation. So this is the for example, we can predict market in two ways. For example, if I say market is going to up, it means I am saying uptrend. If market is going to be down, I am saying that market will have downside. It is called downtrend. Friends, in some time, market is going nowhere. This is the third scenario. We can say market is sideways. For example, market is range bound. For example, in a particular range, market is going to trade for a days, for the month. We can say in a particular time frame that market is sideways. So basic knowledge of market is must. You should have basic understanding, or you should have basic skills to predict that market is going to upside, market is going to downside, or market is going to sideways. But friends, as a normal layman, I can make money in only and only trending market. For example, trending market means what? What? For example, market is going up, then I will purchase and I will sell at a later period of time with a profit. If I predict market is going down, I will sell right now. I can purchase at a later period of time. But if market is sideways, I will not go into money in terms of securities. But in terms of options, yes, you will definitely get the money in sideways market as well. That is why the beauty of option here begins. Friends, this is not much easy. As I'm just saying, you should have the basic knowledge of understanding how the market along with the options are working. So at a later period of time, you can decide that where will you going to uh, the intervene the your skills in terms of the option market. So coming to the trends, we can say if uptrend or downtrend, I can say market is directional. Market is going to the into the particular direction. So this is called uptrend or downtrend. Second, sideways. What does it mean? Market is going nowhere. If I do not have any direction, I can be said I am a non-directional. So these are the basic terminologies, either directional or non-directional. Directional means either upside or downside, and non-directional means neither upside nor downside. We will skip the purpose of derivatives, risk management. We will also skip trading in options. Uh, Purpose is very much defined here to generate income or to take advantage of price movement. As I mentioned earlier, uh, two type of trends, either directional or non-directional. So you can take advantage of price movement in a directional trend and to generate income in non-directional trends. So friends, coming to the buy versus sell. Now important concept is coming. Uh, for example, if I wish to buy option, I need to be right on direction. It means I should have clarity whether market is going up or whether market is going down. That is called direction. I must be right on direction. Second thing, I must be right on timing. For example, option is having with the expiry date. I must be right in terms of time as well. For example, if I predict that index is going to cross or not with that particular period of time, which is called timing. So I need to be very much right on the timing. Third is strike price. I need to be very much right on strike price. I have just displayed one option chain where you have seen the different strikes. So choosing a right strike price is also one of the important aspect in option trading. So I need to be right on strike price as well, and I need to be right at the momentum. Momentum means a particular speed at which the underlying asset is changing. For example, if a particular script is going to up from 1000 to 1100, it means it should have the momentum. It is not called that it is not called that momentum is there if the script is not moving in right direction at the right speed. So momentum is which is referred along with the speed, which is called momentum. So at the right speed, you can be on the right strike, you can be on the right direction along with the right strike. So these are the four important aspects when you are buying any particular option. Coming to selling part, selling is very risky. You should not sell any option if you do not understand the risk management. If you do not understand the very basics of the stock market, you should not sell. Selling is very risky. Theoretically, you can have unlimited risk. You can go bankrupt as well. So selling is very risky. Violent move, any positive or any negative news coming to the market is a usual thing. Anything can happen in the market. One violent move will destroy you. So selling is very risky, but with the proper risk management system, with the proper expertise, you can sell as well. High margins, because this is not for the small players. This is not for the design to the for the retail traders. These are the options which is widely used by the big fund houses and HNIs to for the different purposes, to speculate, to hedge their portfolio as well. So it requires very high margin. Of course, returns are very limited. If you are selling any options, your returns will be very much limited because you are collecting the premium from the market, and those premium collected are the limited ones, and you will be limited to those premiums only. So here the returns are very limited, but it again comes with the probability. Buying the options are very much less probability on being right, but selling options are having great probability of being right. So we will see in a later part. I will have just 10 to 15 minutes, so I will cover the important concept and one or two strategies as well. I will try my best. For example, friends, we have discussed IV versus price. So we can divide this into the five parts to understand in a better way. For example, this will be the five scenario. First is very low IV, then option prices will be very cheap. Second is low IV, cheap prices. Third one is medium IV, moderate prices. Fourth one is high IV, we can say inflated prices. Fifth one is very high IV. It means very inflated prices. So price and IV has the positive correlation. Increasing in the IV will result into the increasing in the price. So friends, certain parameters are dependent on this concept because if I need to be a seller, please listen me carefully. If I need to be a seller, then I will love to sell a particular product or particular asset at the higher price. You will agree with me. If I am a seller, I will love to sell at a very higher prices. So what is the ideal condition if I wish to be a seller? Medium to high IV will be the ideal condition if I wish to be seller. In a scenario of low and very low IV, I will be buyer, or I wish to be buyer because the prices are very cheap. So these are the important concepts where you can play the option with this mindset. Coming to next part, knowledge of market. As I mentioned earlier, we need to be directional or non-directional. So coming to first part, we will discuss each and everything about the directional market. Friends, coming to next, what is direction? Direction is a movement of any particular asset towards a particular side. For example, if I wish to be a buyer, or if I wish to enter in a directional scenario, then best entry time will be the turnaround point. In a technical terms, you can say at the support or at the resistance point, you can enter directional part. For example, you might have heard the words that I bought this at a bottom price. Bottom price means what? From where the price will turn around, which is the best entry time. If you are playing directional, then your entry should be, or you should try to enter the markets at the turnaround points. Second thing, yes, friends, this one is the example. I will I will spare 2 to 3 minutes in these slides because I will explain one important concept. For example, my view is directional. I am predicting that current Nifty price is 24,500 in upcoming days, which can go up to 24,800 or 25,000. So my prediction is in a direction. In which direction? In a upward direction. So I am a directional, I am having the directional viewpoint towards the market. So I can play in a different way. For example, friends, if I wish to be a buyer of an option, so I can say, if I predict that market will go up to 25,000, then in this view, I can or I may buy a call option having strike price of 25,000. This is my directional view, and I am going to enter in a way that can be beneficial to my prediction. So first scenario is I can have two options. I just repeat to avoid any misconceptions. I am a pure option trader. Please listen me carefully for next 2 to 3 minutes. I am just repeating each and everything from scratch. I am an option trader. I do have choices of buying call or buying put. Two components, either put or either call. When should I buy call? If my prediction is that market is going to up, then I should buy call option. When should I buy put option? If my prediction is that market is going down, then I will buy put option. Now think differently, friends. If I say market will touch 25,000 mark, I can say in a different way that market will not go beyond 25,000. For example, what my prediction is, market may touch, first one is market may touch 25,000. And my second prediction, I can say it in a different way that market will not go beyond 25,000. I hope you are with me. So in two scenario, I am predicting market upside. So I will play in a two different way. For example, first one is if I say market will touch 25,000 mark, then I will buy 25,000 call option. Second thing, if I say in a different way that market will not cross 25,000, then I can sell. What can I sell? I can sell 24,500 put option because market is not going down in my prediction. So market will only go up. This is my prediction because I'm a directional. In other way, I can sell 25,000 call option as well because market will not go beyond, which is my prediction. So I can predict in two way. First is market can touch and market will not go beyond a particular point of time. So this is called directional way. Coming to directional strategy, we can have credit spread. If there were two options as discussed earlier, I can be a buyer of an option or I can be a seller of an option. We have seen the pros and cons of buying versus selling. So here I can say selling is having more edge, selling is having more probability of getting success. So we will start this directional view by analyzing credit spreads. So what is the ideal situation? Credit spread means what will be the ideal situation of volatility. As we mentioned, I will love to say at higher price. So my ideal situation by entering into the credit spread will be my IB will be very much inflated or inflated. We can say in moderate terms also we can enter, but not deflated or very much deflated. We cannot enter into the credit spread. As we discussed, this is the higher probability with the limited returns. So you can have pros and cons in your mind. What is favorable? IV fall means once we have sold a particular asset, we would love to have the decrease in price to gain ourselves. Theta decay is also one of the important concept as discussed earlier. By the passing a particular time, day or weeks, you will have the theta decay component in your favor. What is unfavor? Delta. Delta is unfavor. Why? If I predict market will not go beyond and market is coming up and up and up, then I will be affected or I will be hurt by the delta. So this is the ideal scenario of credit spread. Coming to very much next debit spread, which is quite reverse from this scenario. Ideal implied volatility situation should be very cheap or cheap. These debit spreads are having lower probability, but which is having high margins. Favorable IB spike. I bought at a lower price, so I will love to sell at higher price. So IV spike will result into the price hike, and delta will also be favorable to me because in a direction which I predicted earlier before entering, if this direction continues, delta will be my favorable component. Coming to the unfavorable component, here is the theta. By passing day or week or time, I will be losing my value of this asset. So I am a buyer. So losing value in a particular asset will not be a favorable thing for me. So theta is here unfavorable. Friends, coming to the one important concept again, non-directional, because when I predict that market is ranging in particular price range, which is called non-directional. So coming to the one hardcore reality is, friends, when you take risk, higher risk, you will get the higher return. If you take lower risk, you will get the lower return. Coming to high risk, give higher return. I here added one red line. The font is showing higher risk gives higher return with lower probability, and lower risk gives you lower return but with higher probability. Now choice is your whether you wish to enter into the higher probability scenario or you wish to enter into the lower probability scenario. Higher probability can generate consistent income or consistent return, whereas lower probability do not have any potentials to make consistency. So coming to our one of the finest example of my presentation, and by this example I will end of my session. So please be with me for next 2 to 3 minutes. Friends, I have taken this recent scenario as today is the holiday in Indian stock markets. So I have taken the closing price of yesterday's market. Nifty was traded at 24613. We can say 2000 24,600 is the Nifty's current price. Now coming to the options concept, I'm just asking about the call options. Then we will just observe the prices of put options as well. Friends, this is the closing price of the options. 2,500, sorry, 25,000 strike price call option. Expiry date is 25th July, and which is currently closed at 87 rupees. For example, in this scenario, I am just discussing two of the scenarios. One is directional and second is non-directional. So please be with me. If I predict that market will go at 25,000, then I should purchase 25,000 call option currently traded at 87 rupees. Second, again, I am repeating, this is not the recommendation, this is the example. If I predict that Nifty will go down at 24,000, so I should purchase put option of 25th July, which is currently closed at 51 rupees and 70 paisa. So these are two the prices. For example, if I say market will not go at a particular point of time, say for example, market will not touch 25,000 mark. So in this case, if I am purchasing call option at 87 rupees, I will lose my money if I have purchased. If market is not going beyond 25,000 by 25th July, I will lose entire 87 rupees, which is called premium. Same way, if market is not going beyond 24,000 by 25th July, then I will end up losing 51 rupees and 70 paisa. Think differently, friends. For example, my view is directional. If I predict that Nifty will not go beyond 24,000, so instead of purchasing 51 rupees, instead of purchasing put option at 51 rupees, I can sell as well. If I predict that market is not going to down, so I can sell. By selling, I will earn this 51 rupee as my income because my prediction is market is not going beyond 24,000. Friends, if I am having non-directional view, I will take more 2 to 3 minutes in explaining this concept. If my view is range bound, for example, if I predict now important one, please be attentive a bit. Now forget all this concept and all these things. Look at the Nifty, which is trading currently at 24,600. Friends, by 25th July, if I say Nifty will not go beyond 25,000 at upside and Nifty will not go beyond 24,000 at downside. So in this scenario, I am predicting the market will be in a range of 2,400, 24,000 and 25,000. I hope you are with me. Coming to this concept, if I explain, if I extend this in a different way, for example, if I predict that market will not go beyond 25,500 and market will not go beyond 23,500 at downside, then which one is having higher probability, friends? Second one is having higher probability because I have widened my range and probability is increased because there are less chances of market is going beyond 25,500 and there are less chances comparatively with if you compare with the earlier options which is 24,000, there are less chances of 23,500 is market is touching or going better, going the down. Coming to the third scenario, if I am just widening my range of prediction that market will be in a range of 26,000 and 23,000, which is very much having higher probability, you can say that within the next couple of days, market will not touch 26,000 or market will not go beyond the 23,000. But friends, look at the premiums. First is having lesser probability. I'm just comparing the team of colon option, we can say pair of colon option, first one in option and first one in input option and first one in call option. So 25,000 and 24,000 is having less probability. 25,500 and 23,500 is having considerably good probability compared to earlier one, and 26,000 and 26,000 and 23,000 is having comparatively wider probability, higher probability coming to compared to the previous one. So look at the premium. Premiums are in correlation with the your return. For example, if you are taking lower risk, your premium or your income will be very much lower. So this is the concept of the strategy in terms of directional or in terms of non-directional. Coming to non-directional, we will be having very much a shorter view because we are running out of time already. Ideal implied volatility situation will be, when should we enter in iron condor? Iron condor means I am predicting that market will be in a range. In this situation, I should enter in a iron condor strategy. Very inflated and inflated will be the ideal position to enter. Again, this is the higher probability with limited returns. So you can think of and you can consider this strategy as a consistently profitable strategy. But keep in mind, this is the purely the educational view. There is no recommendation because, friends, there are certain other parameters which which is comprises of risk reward, strike price, and other Greeks as well, which have not been covered in this webinar. So you cannot enter and jump directly into the option markets. This is the overview of the options trading. Again, here the winning probability, as I mentioned, will be the best probability compared to earlier ones. So wider range, wider probability with limited returns, you can consider this kind of situation, keeping mind the risk versus reward along with your trading nature and portfolio size. You can decide at your own. But please, friends, now I conclude my session. There is no scope of question answer. I must thank the Institute of Chartered Accountants of India and the Akanksha ji, uh, who is moderator. I'm just ending my presentation here, and I believe that whatever I said in a shorter period of time, in a quicker manner, you were able to understand it properly. Thank you very much, friends. Thank you. Handed over to the Akanksha.
Thank you, Hardik sir, for such an enlightening session. It was really an eye opener for all of us. As we do not have any queries from any of the members, we can directly proceed with the second session. Our second speaker, CA Nirmala Soni ma'am, has over 10 years of experience in auditing, taxation, costing, payroll, budgeting, export and import, etc., and specializes in project financing, auditing, and startup mentorship. She is also registered with Insolvency and Bankruptcy IBBI for asset class, securities, and financial assets. Over to you, ma'am, for your session.
Thanks, Akansha. Thanks to the good evening. Thanks to the ICICP committee, Chairman Sir, Purushottam Sir, and Vice Chairman Gyan Sir for giving me this opportunity to share my views on this platform. And the co-speaker, Hardik Sir, has shared a very good topic, derivatives. So it was very knowledgeable session. So my today's presentation would be on startup valuation. So before starting, I would like to share some things. Like startup is an emerging field for the chartered accountants. They can directly contribute to the ecosystem by giving their services to the startups to scale up their business from the initial stage, or they can directly contribute to the ecosystem by having their own startups. There are many CAs who have started their own startups. Like if we take the example like CA Namita Thapar, CA Aman Gupta, they are the successful entrepreneurs. Since the CAs know in and outs of all the business, they can run the business very well. The Namita Thapar has a good startup like Anchor, and Aman Gupta has a good startup like a board. So it is very emerging field. So chartered accountants should divert their scope of work from auditing and taxation to this startup area also. Let me share my presentation. Hello, Akansha. Whether presentation is visible?
Yes, ma'am, your screen is visible.
Okay, just okay. So our today's topic is startup valuation. So in this topic, we would be covering various topics like who can be the registrar valuer. Since startup valuation is done by the registrar valuers, so who can be the registrar valuer? What is the asset class? What is valuation? Which approaches to be applied for the valuation of startups? What is startup? Life cycle of the stage of the startups. Funding options for the startup, why startup fails, startup valuation method with the examples. So all this topic would be covered one by one. So who can be the registrar valuer? So registrar valuer is a member of IBBI as a valuer. So previously there was the valuation was done by anybody. The valuation was not proper. It was a window dressing. Since means if the valuation of the business is 100 and it is showing up 50 crores, so there was a window dressing. So to streamline the process of this valuation, the Companies Act amended in 2017 and come with this regulation section 247 in the Companies Act, and it deals with the company's register valuer and valuation rules 2017. So this regulate all the valuation work. It regulates the register valuer and all the process of the valuation. What are the valuation standards? Which are valuation approaches to be applied for the valuation purpose? It is a regulatory authority for the like regulatory authority would be IBPI, and all the regulations would be done by them. So valuation can be done in respect of any property, shares, debentures, any business, goodwill, or any other assets which is having the worth of a company or its liabilities. So valuation is done by the registrar valuer, who is a member of RVO. So RVO is stands for the Register Valuer Organization. So RVO is the mediatory. We are registered with the RVO, and RVO is the main body registered with the IBBI. So there are 16 RVOs as present, and ICI RVO is one of them, which deals with the various asset class. So typically there are two types of assets class, like technical as well as financial. So in technical, it would be a land and building, plant and machinery, and financials, it would be SFA, securities and financial assets. So the technical part is taken care by the civil engineers, mechanical engineers, or electrical engineers. But the financial part, SFA, is taken care by the CAs, CMS, CAs, MBAs. So all the financial businesses valuations are done by this professionals. So this was about the registrar value, who can be the registrar value. So then what is the valuation? What do you mean by the term valuation? So valuation is related to a specific point of time. So what is value? Suppose any business is valued 10 lakh rupees right now. So after 1 year, it would be at 12 lakh or less than 10 lakh. So it is specifically to a point, specific to a point of time. So what is being valued? Whether shares are valued, business is valued. So purpose is very important in the valuation. What is valued and why it is valued. Whether business is valued for the funding purpose, or whether business is valued for the merger or acquisition. So what is valued and why is valued is very important. Whether shares are valued for the IPO purpose, whether shares are valued for the right issue, buyback issue. So it is very important what is valued and why is valued. Purpose is very important. Whether we are valuing business as a going concern, whether it is for the expansion purpose, or whether it is for the liquidation purpose, like a merger or acquisition, or any company which is going into insolvency, like a Byju's. Recent example can be a Byju's. Or for the merger or acquisition, the business is valued for the merger or acquisitions. So basically, there are three approaches for the valuation: cost approach, income approach, and market approach for the valuation. So any asset which is having a worth is can be done valuation. Like valuation is a process of appraisal or determination of value of a tangible assets, or of an asset which can be a tangible asset or intangible asset, like goodwill, royalty, securities, liabilities, or specific businesses as a going concern. So, as a Professor Damodaran said, the valuation discipline is neither a science nor an art. It is a craft that one learns by doing it. So, more and more assignments one do, the better they can do the valuation work properly. So, basically, there are two types of valuation: absolute valuation and relative valuation. So, absolute valuation means when we do the valuation based on our company's own data, like financial statements, audited financial statement, projections of the companies, management decisions, management strategies, that it is called as absolute valuation. And relative valuation means when the valuation is done by taking other companies as an example, like a PV multiple of other companies, beta of our companies as a multiple, and we do the valuation. It is called as a relative valuation. So basically, in case of absolute valuation, cost approach as well as income approach is the absolute valuation, and if we do the valuation as per the market approach, it is a relative valuation. So basically, three approaches for the valuation: market approach, income, and cost approach. So all these three approaches are based on the economic principles of price equilibrium, anticipation of benefit, and substitution. So basically, in these three approaches, there are various methods or techniques for the valuation. Like if we go for the cost approach, it has the net asset value or liquidation value. Or if we go for the income approach, it is DCF method, yield method, relief from royalty method, excess earning method, incremental cash flow methods. If we go for the market approach, it can be a market price method, comparable companies multiple method, comparable transactions. So it is not we can go for only one approach. It is up to ourselves. If we find that the income approach, the projections received from the management is not up to date, we can have other approach also. We can go for the market approach or cost approach. So based on our judgment or based on the facts and figures given by the management, we can decide that whether we should go for one approach or two or combination of approach, or same we can give the weightage to the each approaches. Like we gave 80% approach percent to the income approach, 20% to the market approach, and based on this we can get the valuation of the business. So this was about the valuation, and who can be the register valuer, who is the RVO. So our today's topic is startup valuation. So we should understand the term startup. What do you mean by the term startup? So startup is like any business which has the innovation and creativity. So it should be very new or unique creation. Like earlier there was one-to-one selling was there. I was a seller, and if any buyer comes to me, I would sell my stationery or ready-made garments to them. But now the thing is that the platform is created, like a Zomato, Naukri.com. The platform is created. So there are n number of buyers, n number of sellers are listed on that platform. So instead of only pipeline selling, there is a platform selling, means pan India selling is there. So to create new things, innovative things, there should be a proper channel. Means we have to register, like if we come the food delivery app, then the various restaurants should be linked to that. The proper marketing should be there. So innovative ideas should be there. Scalability, the business should be such that it should have a scalability. Means it should not be restricted to one state or one region or one city. It should be a pan India basis, or it can go to international level, or it could have a multiple regional offices, or like a Zomato, it is having a presence all over India as well as international, so that it can give the maximum number of jobs to the delivery boys. Risk taking, since it is an innovative idea, it is having much risk associated with it. So the co-founders is at a much risk while starting a startup. So startup basically it is formed to solve the real life problems. to have the solution for that real life solution. They can have it is as per the society needs. So then only it can have the investors, funders, so that if there is a growth, then only the investor can invest in such type of a business. Like there are waste management startups, so they are solving the this problem of a waste. So the waste are utilized for the good products, like plastics. From plastics, they are making t-shirts, they are making shoes, they are making any uh, bags. So the waste product are utilized for the good product. So in a startup, the 3 P's are very important: people, product, and process. So people means the founder, co-founder, their skills, expertise are very important. And the audience, the market is very important. The target audience, the product is made for which generic miss market. Like if a baby product like Mama Earth, so they are making the products which is good for the babies. So target audience is set that babies, for the newborn babies, the products are there. Product. So product is very important. They should be liked by the customers. The product should gain the confidence of the customers. And the process. The whole process, in case of a startup, the process should be streamlined. Suppose anything was having time is to get taken was 3-4 days. Now it should be streamlined, that it should be made within 3 to 4 hours. So the process should be streamlined. So there is no definition of the startup, like if we deal with the Companies Act, there is a definition of the companies. If we deal with the Partnership Act, there is a definition of a partnership firm. What is a partnership firm? But for the startup, there is no act as such. So there is no definition of the startup as such given in anywhere. But only one definition is there in the startup, which is given by the Ministry of Commerce and Industry, Department of Industrial Policy and Promotion, DIPP, which is now termed as a Department of for Promotion of Industry and Internal Trade, DPIIT. So what definition they have given? The entity shall be considered as a startup if it is having its existence less than 10 years. So up to 10 years from the incorporation, then it can be considered as startup. Like a Zomato, it is running from the 13 to 14 years. So it would not be having the benefit of a startup right now, because it is beyond 10 years. Private company, it should be a private company or partnership or LLP. So proprietorship cannot be a startup. It should be private company, partnership firm, or LLP. Turnover should be less than 100 crores in a year. Working towards innovation, development, or improvement of product and process of services. It should have a scalable business model, like high potential of employment generation and wealth creation. So high employment generation. So basically, benefits are given for the startups. Tax holiday benefits are given. So same definition has been used by the tax department also. Tax department using the same definition of startups for tax breaks. Even the SEBI has adopted the same definition under AIF, Alternate Investment Funds Regulation Income. Of same definition is used by all the 3 ministry, all the 3 departments. So once the startup gets the DPIIT registration, means they are recognized startup. Means like a company gets the certificate of incorporation, they can have their existence, means they can start a company. So in case of a startup, there is a startup regulation is done by the DPIIT registration. So what is the ecosystem of the startup? So to develop this startup, there should be a proper ecosystem which can help the startups from the initial stage to scale up. So there are various persons in the various types of organization in the ecosystems, like incubation centers. So incubation centers means the centers which provide the benefit to the startups. Like startups, the founder, the co-founder have only idea, but they don't have the funds for the starting of the business. They don't have the space or they don't have the furniture, laptop. So these incubation centers provide them space, provide them the required infrastructure like a laptop, furniture, Wi-Fi, everything is provided to them so that they can concentrate on their idea, so that their idea can be implemented in the best possible way. So in integration centers, few integration centers don't charge anything if they are new, but some charge very nominal fees so that all the new startups can register with these integration centers and get the proper channel. In these integration centers, there are various mentors or registers like financial mentors, legal mentors. If there are, since if any founder or co-founder is they are making an app, but they are not good at the finance part. They are not good at the marketing part. How to market this product? How to do means all the proper documentation. So these mentors help them to guide proper, so that these mentors help them to means properly document all those documents from initial stage, how to market the product, how to target the audience, means they give the ideas to them. Banks, government, interact, all these form a good ecosystems so that the startup can work very well. Like there can be big companies, universities, funding organizations, service provider, research organization, support organizations. All these are the part of the ecosystem. So basically, there are three stages in the startups. Like if they are very early stage, only idea is there, or MPV, means minimum viable product. A small means only product is launched, product is made. Then there is a growth stage, means at least a working of startup for 2 to 3 years. More than that, means the product is liked by the customers. They have gained the confidence of the customers, and their product is having the means international as well as international presence. They are earning good, like Zomato. Then they after that they can go for the IPO also. Mature startups can go for the IPO, like Mama Earth and Zomato has gone for the IPO. So in early stage startups, they can be valued as per the asset-based, cost-based approach. Since there are many very less cash flow in the initial stage, there is no guarantee that the company will be able to operate as a going concern. So in the initial stage, if we want to value the startup, then it can be by the cost approach. Suppose any software is made for and the cost for that making the software is 5 to 10 lakhs, then the valuation would be done by this figures. Or we can use for market approach, like if we do any startup is there, like which is very much like Zomato. So Zomato valuation is this. So if the Zomato was in this initial stage, what was their valuation? So we can go for the market approach. We can use the multiples, P multiples or market multiples. In case of a growth stage, since the market is very much liked by the customers, product is market fit. So we are getting good revenue, or then we can give means have the proper projections of the revenue. So we can go for the income approach. And in case of a mature startup, we can go for the market approach, because we can use this approach, like our products can be listed, our products can be go for the IPO. So if the startup is going for the IPO at a price band of this, and our startup is in the same field, like EV field, then what will be the price band of our startup? So we can go for the market approach. So mostly, these are the 7 reasons why startup fails. So mostly the startup fails because of insufficient money, 37%. So if they don't get the funds at the proper stage, their survival gets stuck. So majorly there would be means proper flow of money. There would be means investors ready to invest in such type of startup. The product should be properly Then the other reason would be the poor management. The founder, the co-founder, since in the startup, the founder, the management, and the shareholder are the one and the same. Since it is a small business, so the shareholder and the management is the same. So the whatever the skill and the whatever the experience of the shareholder, they only manage the business. If they are not proper, they don't have the proper skill, the startup will fail. Then there lack of consumer demand. The next would be the lack of consumer demand. If the what the product you have made, it is not liked by the customer, it is not solving the any society needs, then obviously the startup will fail. Then the other reasons are pricing model, poor marketing. If marketing is not done properly, customer satisfaction, legal issues. Like legal issues, the recent example would be Byju's. So since the Byju's don't have made their proper financial statements on time, they are not able to predict that their marketing expenses were very high. And the auditor of the company has resigned. The because of all this, the share means the investors have resigned from this startup. The investors have pulled their money back from these startups. So the Byju's was having the valuation of 22 billion before, 22 dollar billion before. Now not having any valuation, they are going into insolvency, and they have to make the payment of there are the NCLT have made the penalty of 159 crore to them. So legal issues are created. If the proper documentations are not done, proper financials audits are not done on time, or everything is not done on time, the startup will fail. So in case of a valuation of a startup, the company goes into various stages, means how the funding should be there. So to understand the funding of the startups, since funding is very important for the growth, expanding the operations, achieving the strategic objective. So the funding of the startups can be in a three form. It can be an equity form, debt form, or alternative funding resources. So if they go for the equity, means any angel investor or venture capitalist invest in a startup, they have to give their share to the investors. So, but in this case, only dilution of ownership is there. Don't have to obligation of repayment. But in case of debt financing, if they go for debt financing, so from the lenders or financial, then there is a promise of repayments of interest payments as well as principal payments on time. Otherwise, if they delay or if they default, their goodwill will be affected. Alternative funding resources such as crowdfunding, escalators, grants. Startups get the grants from the, if there is a very unique idea, very innovative idea is there, then they get the grants from the central government, which is up to 20 lakhs rupees, and even they get the funds from the incubation centers. So it depends upon which type of startup is there, what are their growth potentials, they get the funds. So for getting the funds from the investors, there should be proper documentation, proper fundraising documentation should be prepared, like business plan should be there, like business plan which properly show market opportunities of the startup, competitive advantage. Since if it is a new in the market, no competitors are there at that time, so it is getting the advantage of being the first. Projections to attract the investors. So proper business development plan should be there. Financial modeling means proper projections of the financial projections should be there. Startup growth potential, what will be the revenue in the future, what will be the capital requirement. Suppose if we are working in a one city right now and we want to have the franchisee in 2 to 3 cities, what would be the extra capital required, what will be the resources we would be requiring. So proper planning of everything, financial modeling. Pitch deck creation, Like if we go for the any interview, we have the resume, CV. So in case of a startup, pitch deck creation, pitch deck is a document which says everything about the startup. Who are the founders, who are the co-founders, when the startup started, what are the business model, who are the competitors, everything about the business of the startup is shown in the pitch deck. So when to value of startup, there are basically the startup are classified into pre-revenue stage as well as post-revenue stage. So basically, as we have seen the Shark Tank. So first question in the Shark Tank, they asked whether this startup is a bootstrap or you have raised any funding. Or if you raised any funding, how much shares you have diluted, ownership you have diluted. So what do you mean by the bootstrap? So bootstrap is a term used when the startup is funded by its own fund or funded by the any personal any savings from the family friends, then it is called as bootstrap, means using the own resources, whether it would be a personal saving, personal computing equipment, garage space to start and grow a company, then it is called as a bootstrap. After bootstrap, then they are funded by the angel investors and venture capitalists. Angel investors, as the name suggests, angels. They are really the angels. Means they are investing in the startups in the very initial stage when there is no projection of the startup, whether the startup will work properly, whether the startup will go down. So, will taking a much risk at that time, they invest in such business. So angel investors. And then there are venture capitalist firm, means bigger firms, investment firms are there, they invest in the startups, and mature startups can go for the IPO. So if they go for bootstrapping, means there are various options for investments. Like if they go for the bootstrapping, then the personal savings and revenues are used for the startups. Then what are the pros and cons? If they go for own funding, then full control of the ownership and the business, no debt or equity dilution. So effective use of resources means whatever decisions to be taken are taken to be quickly because no other management is there. Cons means limited source. Suppose I am having only 10 lakh rupees and other, but I want to expand the business, but I cannot expand the business without having any much funds. Slower growth potential, higher personal risk. Since whatever I have a personal saving, I have invested in the business. Then if I go for the angel investors, who are very good, means wealthy individuals, high net worth, NE, high HIN, high investment value investors, which give their investments in the business for the equity. So, like in Shark Tank, they use their own funds to invest in the startups, but they ask for the equity, 3%, 4, 5% based on the valuation. Then, if you use that investor funding, what will be the pros? Means access to sufficient funds, we get the funds on time, mentorship and industry connections like Amcure. So if any startup is of a pharma and they get merged with means Namita is ready to invest in that pharma industry, a pharma startup, then obviously they get the connection of other the means distributor of the pharma which are listed on a Amcure platform. Flexible investment terms, but there are cons, means equity dilutions, means we have to dilute the equity, loss of control, means we have to means do the business as per the management with all the boards high expectations. They create the pressures also sometimes because they have means they are invested so much funds in the business, so we have to do the decision based on them. Venture capitalist investment firms which have the high potential, have growth, they also invest in the startups for the exchange of equity. Then we get the large amount of capital, expertise, and mentorship from the experienced investors. Credibility and validation means our credibility increases since we get the orders we complete our orders on time because of the funds. If we are not able to do our orders on times, then when the venture capitalists invest in the business, there is a dilution of the funds, sufficient dilution of the business, like utility dilution, high expectations, and pressure for the rapid growth, potential loss. Then, if we go for the crowdfunding, means crowdfunding means a small amount is collected from a large number of people. Suppose 100 rupees is collected from a 1 lakh person, then it is called as a crowdfunding. So access to large pool of potential investors can serve as marketing tool. Means we can give the means reward based crowdfunding. If we means any app, if you refer any this app to any person, then you will get the cashback of rupees 100 rupees, such that promotional can be there. So in this case there would be no dilution, but all this process take time, so it would be a time consuming process, requires a strong marketing campaign. Means there should be strong idea, so that only then one person can refer to another person, then another person can refer to another person. So it is, so proper marketing should be there. Risk of not reaching the funding goal. Suppose we have assumed that 10 lakh rupees is to be collected, but there can be chances that we collect only 5 lakh fund potentially. So we cannot get the things on time. If we go for the bank loans, if startups goes for the bank loans, so if startup go for the banks or loans from any financial institutions, then there is obviously there is no dilution of equity, but a fixed repayment of schedule is there. Means we have to pay the interest as well as principal payments on time. Interest payments can get on is a tax deductible as expenditure, so we can get benefit of this interest payments. But we for these loans we have to give our collateral security. We have should have the good credit history, then only the banks will give the loans. So if any default is made on then our means image will be lost, our startup will typically fall down because of that. If we go for the grants and competition, so and if compliance is good, if they every so you have to report this. You and so
There is some network issue at Nirmala ma'am's end. Nirmala ma'am, kindly check it. Technical team, please ask Nirmala ma'am to rejoin. I request the members to kindly be patient. Nirmala ma'am will be joining us shortly. There is some network issue at her end.
Sorry, it got disconnected. So the main topic, startup companies valuation, how to do the valuation. So in case of valuation, since the startup is an suppose the startup is a very new, so limited history. So if we are valuing the startup, so we should be very careful because there would be no history of that startup. Financial challenges to raise the capital. So in initial stage, the funding would be very less. The more focus would be on the R&D part, no revenues. So focus would be on intangibles. So success ratio of startups are very less. They are means if they survive for at least 3 years, there are much chances of their survival. Success depend on management expertise. So mostly the success of startup depends upon the management expertise. Zomato recently brought a former Make My Trip as a CEO. So expertise is very much management expertise is very important or demand constant innovations. So model scalability is very important in case of a startup. So if the startup would they should be constant renovate their ideas, introduce new product, new schemes, free gift, free cashbacks or something. Annuity should be there every time. So in case of startup valuations, a lot of guesswork is there. So as a register value, there can be different value. If I do a valuation of a startup, I've done the valuation as a 50 rupees per share. But another valuer who is taken the another assumptions, and as per him, the valuation is 55 rupees per share. So it depends upon the assumptions. Lack of historical data, forecasts are uncertain. So even we go for the valuation means of projections. So for in case of a startup, the forecasts are very uncertain. So it is a valuation is a complicated mix of science and art. There are multiple methods. Means I do the valuation as per the DCF method. If another registered valuer is appointed, then he can do the valuation as per the venture capitalist method. So it depends upon the valuer to value. So these are the 9 methods for the valuations. So book value method, cost to duplicate method, DCF method, first Chicago method, venture capitalist method, market multiple method, Berkus scorecard valuation method, risk factor simulation method. These are the 9 methods based on which we can do the valuation. So book value, as the name suggests, book value. So there is nothing much in that. It is basically whatever the assets as on the balance sheet we are having on the balance sheet date, valuation date. We take the value of that assets less any if any loans are there or any debts are there, we deduct that debts, and whatever left is the valuation of the business, book value method. So but this method does not consider the growth or revenue. So we in normal practice we don't do the valuation as per this method. Cost to duplicate method means as the name suggests, a cost to duplicate means if I want to duplicate any startup, what would be the cost? Suppose suppose Zomato is a food delivery app, a food delivery startup. If I want to make another startup as same as a food means Zomato means like Swiggy. So if a Zomato is having the cost of rupees suppose 10 crores, so another startup is made, then it would have a similar costing like it would be a 10 crores or a 9 crore or 11 crore nearby that. So in practice also we don't do the valuation as per this method, because this method also does not project the future of potentials of the startup, generating revenues, what would be the revenues in the future, profits or return on the investment, what would be the return. Suppose any investor is invested in the startup, what return they would be getting in future, or does not capture the any intangibles like brand value. So this we do not consider. Then comes the DCF method. So in practice, we follow DCF method for doing the valuation. Basically, the DCF method is followed much for the valuation. So in DCF method, what we do, we discount the future cash flows at the required rate of investment. And projectly, the discounting rate would be higher. Since in the startup, the risk is high. So we take the higher discounting rate and the discounting would be done. So in case of a DCF model, first we should understand the business. What is the business? What is the business model? Whether it is into EV, whether it is into solar. So we should understand the business. Gather historical cash flows. What are the previous cash flows were there? Means they are having proper EBITDA or future is negative EBITDA was there, or so audited financial statements should be there. Then we should have the projected financial cash flows. Normally, we take the projections from the management. It should be around 5 years projections we take from the management for the cash flows, and we discount this cash flows to get the valuation. We calculate the terminal value of the business. Terminal value is the value. Suppose terminal value is the value of the business. If we sold the business in the near future, what will be the value of the business? And the same business would be have foreseeable future. So we calculate, means we are not into going into liquidation or anything. So foreseeable future would be have startup with having foreseeable future. So we are calculating terminal value and discount the cash flows. So this is the example. Suppose we get the projections from the management like EBIT, we deduct taxes from that, then we get net profit after tax. We deduct any investments made, means any capital expenditure is there. Then we add back the depreciation. Since depreciation non-cash flow or non-cash items, we add back the depreciation. Any investments in working capital, we have to deduct in this working capital. Then we get the free cash flow available to the firm, FCFF. Then we, in case of, if we get a FCFF, we should discount by weighted average cost of capital. If the capital structure of the company or startup having the debt element, then we can go for the weighted average cost of capital. Otherwise, we have to calculate by cost of equity. We have to discount by cost of equity, and we have to calculate free cash flow available to the equity shareholders, not firm. If there are no debts, if there are debt, then there is a weighted average cost of capital. Then we discount this weighted average cost of capital based on the discounting factor. Then we get the enterprise value, total value of the business. So how we get the weighted average cost of capital? So we first have to calculate the cost of equity. So cost of equity is calculated by CPM model. So CPM means a capital asset pricing model, CAPM. So we have to calculate cost of retained earnings. So we take treasury bill rates. So 10 years treasury bill rates plus beta of the sector. Like if you are valuing any IT sector company, then we go at least take a 5 to 6 IT companies. Then we take average beta, or beta we can get from the Damodaran website. We can use that Damodaran website beta for the valuation, which is very every half yearly they give the project beta of the each sector. So it is IT sector, auto sector. So we can use take the beta from that, or we can give take a, if it is IT company, then we can use IT companies like Infosys, Wipro, F4, TCS, 5 to 6 IT companies, and average beta. And a beta can be available from various websites like moneycontrol.com or Yahoo Finance, Skinner.in. There are various websites available there which gives the beta information. Then market risk we have to calculate. So market return, first we have to calculate. Market return is nothing but the BSE Sensex return, means we take normally 20 years return, like a much is giving right now. Market return less risk-free rate. We get the market risk premium. And once we get the cost of equity, we apply this cost of equity into weight of equity and a weight of debt. Like if we are having 16% equity and 40% debt, based on that we calculate the weighted average cost of capital. Then since we get the enterprise value, from enterprise value we have to deduct debt, minority interest, market value of preference shares, plus add back cash and cash equivalent, so that we get the equity value. since we give the valuation equity per share, so we have to know the equity value of the company. So equity value, once we get the equity value, we divide by the number of shares, we get the price per share. So in valuation report, we give the value per share. Then there is a market multiple method. So in case of market multiple method, we use normally two types of multiples, like equity multiples or enterprise multiples. So in case of equity multiples, this is P multiple, price to sales ratio. We use enterprise values, EV upon revenue, EV upon EBITDA. So it is very easy form of doing the valuation base. We have to just find out the multiples and do the valuations. It is a relative form of valuation, but properly comparable should be proper. Otherwise, our valuation will go wrong. Suppose this is an example. So ABC company, if we do the valuation of ABC company, we expect the next year forecast would be 1.5 EPS. And we have the comparable companies XYZ corporations. And XYZ companies forecast EPS is 0.8. And current share price is 20. Then PE is 25. So if we want to value ABC company, we can use this information, PE multiple 25. So 25 multiplied by 1.5, we get the price of ABC company shares, 37.5. Also, we can do the multiples, we find out the multiples and take the averages. Like if we go for the beverage company, so we can go for the Coca-Cola company, PepsiCo company. So all this information can be easily available from the websites. We can go take the financials from the websites. We can get the valuation like EV upon sales, EV upon beta. Then we can obviously do the averages and do the valuation of our startup. Then there is a first Chicago method. This is also extended form of DCF method to do the valuation. But in this, we expect that there would be three scenarios for the valuation, like worst case scenario, normal case scenario, best case scenario. Valuation is done for each of these situation and finally with the probability. So like this, we expect that the valuation of the company is a base case. Means if the as per our projection, if the business is doing good, then valuation would be 120 million. And if we expect that there would be much growth in the business, then the valuation would be 180. If business doesn't do as per our expectations, then the valuation would be 50 billion. And based on these cases, we give the probabilities. So valuation into probability, we get the average valuation of the business. Then we have the venture capital method. This is normally is followed when doing the investments. So in case of a venture capital method, there are the two terms, post money and pre money valuations. So in case of post money, this is a case study. So pre-money and post-money differ in timing of valuation. So pre-money means without taking any latest funding in the valuation. And post-money means including the latest funding capital injection. So if we take the example, like Penelope Venture PE starting company want to invest 4,000 million and they expect a 40% return. And a similar type of business is having a EBITDA of 5,000 million for 5 years. And EBITDA multiple is 6 for 5 years. It is given. And best system is likely to have a debt of rupees 2,000 billion and cash balance of 600 billion. So what ownership share should they ask? What is the post-money valuation and pre-money valuation of the startup? So required rate of return they are asking is 40%. And their period of holding the investment in the company is 5 years. And they are investing 4,000. So an EBITDA of this company is 5,000, similar, and multiple is 6. So enterprise value, if we multiply 5,000 into 6, 30,000. So 30,000, this is the enterprise value. We should have the equity value. So we add back cash and cash equivalent 600 and deduct 2,000 as a debt. So we get an equity value 28,600. But this 28,600 is 5 years afterwards. So we have to discount this and get the present value. So when we discount this by required rate of return, this is 40% into number of years. Then we get the valuation as a 5317. So 5317 is post money valuation, means including a 4,000 million in the business. And if we deduct this 4,000, then we get the pre-money valuation. Even we can take one more example. Young ET Limited company is expected to go live on public, means they are going for the IPO after 10 years, and they're expecting that revenue would be 95 crores. Another P multiple of similar at tech company is a 20, and they are expecting 45% return. So exit value would be nothing but 95 crores into 20, 1,900 crores, and the value of the company would be nothing but 900 crores. If they we want 45% return, we have to discount this 45% raised to number of years, 10 years. Then we get the 46. This is the value of business currently. Then there is a Burkus method. In this Burkus method, we assign the range of values. Instead of giving one value, we assign the range of values. But Burkus method is not followed usually in India. So in this, we assign range of values based on these 5 factors: sound idea, prototype, quality management team, strategic relationship, product rollout, or sales. So all these 5 elements are taken care while valuation. Then there is a scorecard valuation method. This is all for the pre-revenue business, so which are not having any revenue generations. So in Burkus, there are 5 5 criteria, but in case of a scorecard, there are 7 parameters like management team, size of opportunity, product technology, competitive environment, marketing, sales, need for additional investments. So all these are factors considered for doing the valuation. And the last method is risk factor submission method. In this method, we take instead of 7 or 5, we take 12 elements to value the business. It can be management stage of business, whether it is a early stage or a mature stage, funding, capital risk, manufacturing risk, technology risk. Since if the startup is having an international presence, then there are international risks are also associated with them, sales and marketing risks. So all these risks are taken care while doing the valuation of the business. So with this, I end up this my presentation. I hope I have properly done my work and done my presentation well, and pass on the information to the all the participants.
Thank you, Nirmala ma'am, for your words of wisdom. It was really an enlightening session. Here,
Thank you.
I would like to add that we have over 400 registrations for today's webinar, and that's really a huge number.
Thank
Now, I
you.
believe we are over with the session, so we can conveniently conclude the meeting. So I thank the eminent speakers, CA Hardik sir and CA Nirmala ma'am, for for deliberating us on the upcoming avenues. And thank you all the members for giving us a patient hearing. With this, I see Akansha Gupta sign off. Thank you.
Thank you. Once again, thank you, ICI, and thank you, Gyan sir, for giving me this opportunity. Purushottam